All right, let's get right into it. Today, we're pulling back the curtain on one of the most essential tools for any trader, the moving average. It's all about finding the real story that's hiding inside what looks like a totally chaotic financial chart. So, you pull up a stock chart, right? And what do you see? It's just this jagged, unpredictable line that's bouncing all over the place. It's a mess. How in the world is anyone supposed to make sense of that? Well, that's the exact question we're going to tackle. Okay, so let's start with the problem itself. It's the sheer chaos of a normal stock chart. You've got these daily ups and downs, pushed around by news, by rumors, by who knows what. It makes trying to spot the actual underlying direction feel almost impossible. Yeah, all that chaos, we call that price noise. And it's this volatility, this noise, that traders and investors are wrestling with every single day. Trying to make a good call based on this mess? It's like trying to steer a ship in a hurricane without a compass. Good luck with that. But what if you could just smooth out that storm? What if there was a tool that could slice right through all that noise and show you the real current flowing underneath? Well, that's exactly what the moving average is for. Okay, let's really dive into this. So, what is a moving average, really? At its heart, it's an incredibly simple but oh so powerful idea. It just takes the price data over a certain time, let's say the last 50 days, and it calculates a single rolling average price. By doing that, it basically filters out all those random short-term spikes and dips. And this is its superpower. It takes that chaotic, jagged line we were just looking at and transforms it into this one beautiful, smooth flowing line. And just like that, you can actually see the trend. Suddenly, there's clarity where there was just noise. So, what's this smooth line telling us? Well, think of it like a Swiss Army knife. It shows you the main direction of the trend. Are we going up, down, or just sideways? It can also act as a kind of moving floor or ceiling for the price. And honestly, it just gives you a really quick read on the market's mood. Is everyone feeling optimistic, pessimistic? The MA gives you a solid clue. Now, not all moving averages are built the same. They usually come in two main flavors, simple and exponential. They're both trying to do the same job, smooth out the price, but they go about it in slightly different ways. The simple moving average, or SMA, is exactly what it sounds like. Simple. If you've got a 20-day SMA, it just adds up the closing prices for the last 20 days and divides by 20. That's it. Every day gets an equal vote. It's steady, it's reliable, and it gives you a very, very smooth line. Then you've got the exponential moving average, or EMA. This one's a little more dynamic. It also calculates an average, but it gives more weight, more importance to the most recent prices. The whole idea here is that what happened yesterday is probably more relevant than what happened 3 weeks ago. This makes the EMA react much faster to new price changes. And this right here, this is the classic trade-off. It's like the tortoise versus the hare. The SMA is the tortoise. It's slower, it's smoother, and it gives you this really clear, big picture view. Perfect if you're a long-term investor who doesn't want to get freaked out by a little market noise. The EMA, that's the hare. It's faster, it hugs the price a lot more closely, and it reacts very quickly to what's happening right now. A day trader might love this for trying to catch a quick move. So you see, there's no best one. It's all about picking the right tool for the job. And as Investopedia points out, that speed is everything for some people. For traders who need to be nimble and react fast, the EMA's sensitivity is a huge, huge advantage. It's designed to give you that slightly earlier heads up that a trend might be about to turn. Okay, so we've got our nice, smooth line on the chart. Now what? How do we turn that visual into something we can actually use? Let's talk about how to read the signals these lines are giving us. The most basic way to read it is just look at which way it's pointing. Seriously, if the moving average is angled up, you're in an uptrend. If it's pointing down, you're in a downtrend. It's that simple. And generally, when the price is trading above that average line, that's seen as a position of strength. If it's below, it's seen as weakness. But things get really interesting when you put two moving averages on the same chart, like a fast one and a slow one. Because when those two lines cross each other, for a technical analyst, that's a huge deal. We call that a crossover. The most famous of these, by far, is the bullish one. It's called the golden cross. Sounds important, right? This is what happens when the short-term average, which represents recent momentum, crosses above the longer-term average, which is like the established underlying trend. When you see a golden cross, it's widely seen as a powerful signal that momentum is really shifting to the upside. It suggests that a longer-term bull market could be just around the corner. It's a big green flag. And of course, on the flip side, you have the ominously named death cross. As you can probably guess, this is the exact opposite. It's when that short-term, fast-moving average dives down and crosses below the long-term one. And yeah, this is a bearish signal. It suggests that all the recent weakness is starting to take over the bigger trend. It's often looked at as a confirmation that a serious downtrend or even a bear market might be getting started. It's a major red flag. Okay, so that's a lot of theory. We've talked about the what and the how, but the big question is, why does any of this actually matter to you? How can you actually put this stuff to work? Well, for starters, it lets you cut right through all that daily noise and focus on what's actually happening with the trend. Signals like those crossovers we talked about can help you make more informed decisions about when to maybe buy or sell or just hold on. It gives you a super quick way to just gauge the general mood. And maybe most important of all, it gives you a system, a data-driven indicator that can help you stop making those emotional, knee-jerk decisions every time the market has a bad day. And this isn't some complex tool that's only for the Wall Street pros. As this quote gets at, moving averages are fantastic because they're simple enough for a beginner to grasp, but they're so effective that seasoned pros rely on them every single day to see that all-important bigger picture. And that really brings us to our final thought here. A moving average is a brilliant, brilliant tool for telling you what has already happened. It's fantastic at confirming the trend that is happening right now, but it's always looking in the rearview mirror. It can't predict the future. So the question it always leaves you with is the biggest one of all. Where is that trend going to go next?